Imagine having a crystal ball that could predict every single economic recession without fail. Well, a groundbreaking new study using supercomputer analysis of 645 million data points might have just created exactly that. And guess what? The next recession, with over 99% probability of occurrence, is not far from now at all.
That's fascinating. And the timing couldn't be better given how uncertain everyone is about where the economy is headed. What makes this study so different from previous recession prediction research?
Well, here's what's really incredible. These researchers found 83 perfect predictors that caught every recession without a single false alarm since 1962. That's in stark contrast to our traditional indicators that have been crying wolf up to 59 times over the same period.
Hmm. So you're telling me all those yield curve indicators that financial media obsesses over aren't actually that reliable?
Exactly right. The standard measures like the 10-year minus 2-year spread that everyone watches, they only achieve an accuracy score of around 0.65, which is barely better than flipping a coin. These new perfect predictors scored a full 1.0. Literally perfect prediction.
Could you break down what makes these new indicators so special? Like, what are they actually measuring?
So here's where it gets interesting. These perfect predictors share some very specific characteristics. They're primarily forward spreads with a 4-year horizon, combined with 1-year moving averages. Think of it like looking at the market's prediction of interest rate differences 4 years into the future, but smoothed out to eliminate noise.
That's quite different from just looking at today's yield curve. And I imagine that longer term view helps filter out temporary market disruptions.
Exactly. You know how the stock market can swing wildly day to day, but show clear trends over longer periods? Same principle here. The 1-year moving average helps eliminate those short-term blips that might trigger false alarms.
So, what are these perfect predictors telling us about the future right now?
Well, that's where this gets really interesting. The researchers have constructed indices based on these predictors that are giving us specific forecasts that point to August 2025. This is huge.
I'm curious about the economic theory behind why these work so well. There must be some fundamental reason these particular indicators are so accurate.
The researchers actually used a new Keynesian model to explain it. These predictors are particularly good at capturing what economists call persistent productivity shocks, fundamental changes in how efficiently an economy produces goods and services.
Like major technological disruptions or significant supply chain issues.
Exactly. Or things like energy market disruptions. The key is that these indicators can distinguish between temporary hiccups and the kind of deep structural changes that actually lead to recessions.
So, how should investors actually use this information? What's the practical takeaway?
Well, first and foremost, we need to stop putting so much weight on those traditional yield curve measures. Instead, focus on these longer-term forward spreads, particularly those with that 4-year horizon. But remember, these are strategic tools, not day trading indicators.
That makes sense. These would be more useful for big picture portfolio positioning rather than timing specific trades.
Right. Think of them as tools for risk management. When these indicators suggest higher recession probability, that might be your signal to start increasing defensive positions, reducing leverage, or building cash reserves.
You know what's really striking about this? The sheer computational power needed to find these perfect predictors. 645 million combinations is mind boggling.
And that's actually one of the reasons these weren't discovered earlier. It took modern supercomputing power to analyze this many combinations and identify these specific patterns. Previous research simply couldn't process this much data.
Looking ahead, what should investors be watching for?
The key is to monitor these forward spread indicators, particularly those with the 4-year horizon, and pay attention to their 1-year moving averages. But don't abandon your other analytical tools. These should complement, not replace, your existing strategy.
And I suppose it's worth remembering that while these indicators have been perfect historically, the future could always bring new types of economic crises we haven't seen before.
That's a crucial point. These tools are incredibly powerful, but they should be part of a comprehensive investment approach. The goal isn't to predict every market move, but to better understand and prepare for major economic shifts.
Let's wrap up with the key takeaways for listeners. What would you say are the most important points to remember?
First, traditional recession indicators aren't nearly as reliable as we thought. Second, these new perfect predictors, focusing on longer-term forward spreads with specific moving averages, offer unprecedented accuracy. And finally, while they're powerful tools, they should be used as part of a broader investment strategy, not in isolation.
Well, this certainly changes how we should think about recession forecasting going forward.
Indeed, it does. And for our listeners, remember that staying ahead in markets isn't just about having better tools, it's about knowing how to use them wisely. Thanks for joining us today, everyone.